Hey everybody, this is Lance from ThetaTraders.com. This video I wanted to go over mitigation techniques and other strategies you could do when you might be getting margin called or are in a margin call. So I had a few members that actually happened to them with the volatility increasing quite a bit the last few days. And we're going to go over some strategies in order to deal with these margin calls. Let's get right to it. So here's a margin call guide. I'm going to leave a Google Doc in the description below if you want to read through it. Anyone that watches this video could watch it, not only members. So here's some tips if you're getting close or are in a margin call. If you're using margin for stocks and futures with volatility being low, you want to use less margin in general, just because when volatility spikes like it has this week, it could increase your buying power requirements. So initially, if you're going to sell, say, a naked put on MES futures, it might only use about $400 or $500 in buying power if the volatility was relatively low, like in the low teens or mid-teens or so. But when volatility spiked up to the 40s on Friday, then your margin requirement will go up quite a bit from that initial about $400 or $500. So there's a rough guide on how much buying power you should use from Tasty Trade. I left the link in the Google Doc here. What I tend to follow is when VIX is under 15, use about 30% or up to 30% of your buying power. Be okay with making a little bit less when volatility is low, just so you're able to handle volatility spikes. If volatility in the VIX is between 15 and 20, you can use up to 40%. And then over 20, you could use up to 50%. However, just be careful, obviously, if volatility doubles like it has in the last few days, then you want to make sure that you're dealing with your buying power requirements. One of the key things is to be proactive in monitoring your buying power use. Some people will just ignore the fact that their margin requirements are shooting up quite a bit, and then next thing you know, you get a letter from Thinkorswim, Tasty Trade, and whatnot saying that you're in a margin call. So be proactive. Check your BP percent on Tasty if you're using it daily. It'll show the amount of buying power you're using at any one time, and this will fluctuate possibly pretty dramatically if volatility spikes like Thursday and Friday. If it's starting to creep up, here are some of the following things you could do. One, close out any naked puts in a small profit or break even. If you did one quite a while ago and it's near expiration, you might still be at break even or possible profit. Then I would close out any naked puts that are at a manageable loss. Have in your trading plan knowing exactly how much you're willing to lose on any one particular trade. If it hits it, just close it out. That will give back a lot of your buying power relief. And you can also buy out of the money puts. This will be for a debit, but if you're buying it out on a money put, you're going to get some of your margin power back. And this will make a naked put into a credit spread or possibly a debit spread, but it'll usually be a credit spread. For instance, when SPX was around 5,500 or so, and let's say you sold a 5,200 put, volatility spiked up and it got near the 5,200, you could have bought around a 4,500 put or so, and that makes it a sold put with a bought put, but it would give back a lot of margin into your account. You could also sell out of the money calls. That does take in more premium, and this would turn your naked put into a strangle because you would have a naked put with a naked call together. This won't necessarily help dramatically, but it could help a little bit if you're able to take in a little bit of a credit. If it keeps dropping down, that naked call credit will start to decay more, and at least that will be profitable. And then you could add funds to your account. Sometimes you'll have to do this, especially if you're not willing to take a loss. If you are using, say, 40, 50% of your buying power before the volatility spike in the last few days, then you might be at the 80, 100%. So you're going to have to put in more funds at that point to deal with it. That doesn't necessarily mean you're at a loss unless you close it out. The volatility will drop down eventually. Sometimes it could take a while. Sometimes it happens really quickly. But sometimes you might have to use extra funds into your account just to deal with these margin requirements. This is the fastest way to satisfy a margin call without touching your positions. And it's not necessarily a debit because you're just putting money into the account and you're not trading with it. If you buy a put, though, that will also satisfy your margin call pretty quickly in many cases. However, it is a debit, so just be aware of that. 6, you could also roll your naked puts down and out. So give yourself a little bit more time for the trade to work out. If you could roll down at a lower strike price, that gives you a little bit more cushion in case we see the recovery. And if you do this after a volatility spike, there won't be much relief there. If you're able to do that before the volatility spike, it tends to help a bit if you're able to go down quite a bit in your strike prices. And again, one of the key things is just don't ignore it. A margin call won't just go away. If you don't respond, your broker can and will liquidate your positions. I've seen a few cases yesterday where Tasty Trade closed out some of their naked puts just because they were over 100% of their buying power use. And you want to be proactive about that. See if you get that margin call letter and then deal with it appropriately. I also left some hedging guides. Anyone could read these. These are good to use if volatility is at a relatively low point, because if volatility spikes up, one of the hedging strategies is to buy naked puts that are really far out of the money. You could also buy VIX calls that will possibly give a good big profit if the volatility spikes up. So yeah, the last few days has been very difficult with the market. If you didn't have any hedging strategies on, it could have been a pretty dramatic loss. Just be aware that this is usually short-lived. On August 4th, this happens where volatility went up to 60 and then it quickly dropped down. There's a decent chance that that might happen in the short term. However, you don't really know when that's going to happen. So make sure you have some hedging strategies in place. Make sure that you're not using too much of your buying power before the volatility spike. And make sure you monitor and manage your trades as they come up. So if you want any more help, I do Zoom calls on thetatraders.com, and you can send me a message at any time. So if you're interested in needing help with your account currently, just send me a message, and I'll see you in the next video.